Hi, everyone. Happy to be here. I guess we can get started. I'll just share my screen. Great. Can you guys see my screen?
Yes, go for it.
Perfect. Great. All right, guys. So wanted to make this session a bit more interactive. So as part of that, two things. One, we're going to try and have less of a content-heavy type of session, where what I'd like to do is kind of walk you through, from a legal perspective, things that you need to know or need to have figured out as you're going through this journey with your fintech startup. And the second aspect of it will be for this to be as interactive as possible. So I would encourage you to ask questions, raise hands, and happy to have those questions come in while I'm talking. Happy to stop and address them immediately. This way we can have more of a discussion and less of a boring one at that. So without saying much further, just to give you a short intro on who we are as a law firm. We are a regional law firm that has offices throughout the Middle East. We're one of the first ones to be set up in the DIFC, and we've been here for now 15 years. We're quite active in advising on regulations, specifically in the UAE, and dealing with regulators on new laws, advising them on it, advising them on the drafts, kind of walking through how to improve the legal ecosystem, so to speak. And it's something that we're very passionate about, especially when it comes to fintech. Myself, I head up our technology media fintech practice, and the last 4 or 5 years have really seen an explosion of activity, not just from a commercial side, but also from a reg side. So we're really seeing the regulators just being more active, and that's been a great thing to experience, and really good for startups such as looking to come and establish in the UAE and in the DIFC. Just to give you kind of an overview first for those of you who are kind of new to the country, and who are sort of trying to figure out how things work in the UAE. The UAE is a federation, so sort of like the United States, where it's separated into states. The UAE is separated into emirates. There are 7 of those. And across these 7 emirates, there are a multitude of different ways that you can set up your corporate vehicle, and different ways for you to different regulations that you would need to abide by as well. There are over 30 free zones in Dubai alone, Dubai being the 2nd largest emirate, the DIFC being one of them, and being a very unique free zone in the fact that it follows what we call common law, meaning that all of the laws are based on the common law system, which is the legal system that is in use in the United Kingdom and in the United States. There are also multiple regulators for you to keep in mind when you deal or when you talk about finance. The one in the DIFC being the DFSA, the Dubai Financial Services Authority. And there are several others, such as the UAE Central Bank, which is a federal regulator. Also the Securities and Commodities Authority, also a federal regulator. So these are things just for us to keep in mind as we go through the presentation and kind of talk about some of the legal aspects that you have or that you should be keeping in mind. Before moving on to the first one, let's also kind of set the scene in terms of important legislations that we want to have in mind. The first one being the UAE Companies Law, which is the governing law for the entire UAE when it comes to setting up a corporate vehicle. And that is apart from the DIFC. So the UAE Companies Law would not apply to the DIFC. But everywhere outside of the DIFC and everywhere outside of the other financial free zone in Abu Dhabi ADGM, this law would apply. For a long time, this legislation was rooted in the concept of having a 50% shareholder in any entity that is, as we call, onshore. And that has very recently changed, where a number of activities are now allowed to be owned at 100%. The next law to sort of keep in mind is the DIFC Companies Law, and we're deeming it the new Companies Law because it is quite recent, coming into effect towards late 2018, beginning 2019. From a regulator perspective in the DIFC, the DFSA has set multiple categories of licenses. An interesting one to keep in mind is Category 3D, which is the most recent category of licenses. And lastly, the UAE Central Bank, which has also been rolling out multiple legislations recently in relation to stored values and with more coming along the way as well. So let's move on to the first issue that I wanted to talk about, which deals with sort of your corporate structure and how important that is as a startup. One of the things to keep in mind is that in the UAE, you cannot carry out an activity without having a license, and that license needs to be promulgated or set out by one of the commercial regulators in the UAE. And there are multiple, as I said earlier, multiple jurisdictions to choose from. So it's important for you to first understand that you need a license. Second, try to understand which jurisdiction is the best for you. And especially as we're talking about FinTech today, understanding which jurisdiction really understands what you are trying to do. What's really great about the DIFC is that you have an ecosystem that understands what it means to be in the technology industry, and specifically from a FinTech perspective, has created license categories and ways for FinTechs to be able to interact in the center without having to deal with onerous requirements that maybe, let's say, harder to deal with when dealing with other potential jurisdictions. So as you figure out what free zone or whether to be based in the free zone or whether to be based onshore, to understand that you really need the correct corporate framework and the correct license to be able to carry out your activity. Another thing to keep in mind is, so we still kind of talked about your corporate structure, is that a lot of times when you deal with startups of any nature, you have co-founders. What that means is that you may have to understand from the get-go who is responsible to do what and who needs to be, let's say, maybe handling more of the internal side of things and who needs to be handling more of the external side of things. Just to give you a very, very simple example. Why we're talking about that from a legal perspective is sometimes it's easy to communicate what every individual should be doing, but it's also very important to put that down in writing and to have that clearly set out where every individual understands what they're bringing to the table and what they're responsible in terms of end product and responsibilities on a day-to-day. And that's where we usually talk about either having some sort of term sheet or shareholders agreement. My preference would always be a shareholders agreement between the co-founders for them to really set out how and what they're doing, who is responsible for what, and how decisions should be made in the future. As a startup, unless you are bootstrapped, you may be looking to raise funding. And as a potential investor looking to do a review of all the documents that are important as part of the startup, they would definitely be asking for what type of document has been entered into between the co-founders in terms of understanding where does equity lie, how can decisions be made, is there anything stopping one co-founder from maybe being diluted for a certain number of years, and so on and so forth. So these are all things that potential investors would look at, and all of this would be covered in a shareholders agreement. Hence the importance of understanding, of having that in place as a basic framework as you go on. So we're talked about, let's say inception of your company, needing to have in the UAE, needing to have a license to carry out your activities. We've spoken about how important it is to have a foundational documentation or framework of how co-founders should interact with each other. The third thing I want to talk about is intellectual property. Now, with any new company, your idea is your original idea is probably the most important thing that you have. Being able to say, you know, this is mine and nobody can replicate it. Now, intellectual property is a bit of a tricky area because there are some things which you can protect and some things that you can't. And figuring that out is important also from the beginning so that you can understand how best to monetize your business. Understanding what type of IP is confidential, what is open source, what can be registered with, let's say, an official government authority in which you can register intellectual property, such as, let's say, trademarks or patents or copyrights, and also whether it's worth it or important right now at that point in time. You know, as you're looking to grow and scale your startup, you also need to keep an eye, of course, on expenses and costs, and understanding whether the cost of setting or of registering that IP at this point in time, or 3 months down the line, or 6 months down the line, or at a certain funding round, is also another important consideration to keep in mind. Now, the IP point is also somewhat related to the employment point, which is the next one. But I'm sort of going to do a small segue here to say that who is creating the IP is also an important element that you have to sort of understand and figure out from the beginning. If you are co-founders that are creating your own IP, whether you are you know how to code, or whether you are an engineer by trade or by experience, and you're able to do that yourself, that's great. But if you are getting a third party, outsourcing the creation of the IP to a third party, making sure that that IP remains your own, and making sure that it cannot be replicated, used, or sold by someone else is also crucial as you look to IP and look to be able to secure potential revenue streams in the future. Sometimes you outsource the creation of IP. Sometimes you hire individuals who are responsible to be able to maybe create or maybe tweak, improve, work on the IP that you have as part of your business. And that's where employment decisions also are quite important to keep in mind. What type of employment, what type of individuals you are deciding to bring on? Will they be full-time employees? Will they be part-time employees? Will they be independent contractors? Will you be just using consultants, or, as I said before, outsourcing to third parties certain functions? This is even more important in the UAE because, in essence, in order to be in the country and have a long-term stay, you need to have what we call a residency visa. And obtaining that residency visa is one that you can only do if you are employed by an entity that has a license. So again, we're going back to sort of the building blocks. So if you do need to hire people, understanding what that entails in terms of liability, what you will be responsible for in the DIFC, which is a very protective environment for employees. There is a sort of, I would say, I mean, we call it end of service, but also some sort of, let's say, a retirement type of scheme that exists for employees, which is called dues. And understanding that if you are going to set up in the DIFC and employ employees who will be employees of the DIFC entity, that you need to register them for dues and be responsible to pay certain monthly amounts into certain bank accounts is crucial to understand, again, your financial exposure and liability. So keeping this in mind and understanding what it means to employ someone in the UAE as part of your employment decision full-time is important. What it means to employ people part-time. There are now ways for that to happen. In the past, it was very difficult. And now there's an actual framework to employ individuals part-time. And then the third one, which is using freelancers or third parties, maybe even outside of the country. What does that entail from a legal perspective? Is there any liability attached to it? And what should you do? Once you figure that out, the next step would be to figure out your employment agreement. And this is another really important point that a lot of startups can sometimes approach in the incorrect way. You need to ensure that your employee, as your co-founder, knows exactly what their role and responsibility is. And all of that is set out in an employment agreement. But also making sure that if anything is created by these employees that are potential IP creators or working on the IP of the business, that this IP continues to belong to the company, that you as the originator of the idea continue to remain control and ownership over tweaks and let's say amendments to your original creation. And you will have employees working on this, and it's important that you ensure that you have that protected. Moving on to the regulatory framework. So a lot of when we deal with startups, especially in the fintech space, they have an amazing idea that they've come up with, and they're trying to take it to market. The issue is that there are barriers to entry, and a lot of times the highest barrier is from a regulation perspective. So really understanding what the regulatory framework is like, and understanding what limitations are like. So just from just as an example, when we talk about data, understanding what data is sensitive, what data is protected, whether you are allowed or able to collect certain data and process it, whether it has to be localized in a specific jurisdiction, or can it be exported to a different one to be processed and analyzed. When we talk about data, it's probably the single becoming the single most important currency for companies. And as a startup, again, in the fintech space, data is going to be something that is crucial to the success of your business for the most part. And if that is the case, you really need to understand from the get-go how much data you will be needing to collect as part of your regular operations, and what is that footprint from a legal perspective and from a financial perspective, as there will also be a cost to being able to comply with active data protection regulations locally and in other jurisdictions. When we also talk about we're talking about finance, definitely, so we have to talk about money, understanding whether you as a business will be dealing with money that belongs to other individuals, third parties, and not your own money. If at any point in time there's any sort of exchange of funds as part of your business model, you need to keep in mind that that 99% will need to be regulated by one of the financial regulators in the country. What kind of regulation will you be falling under? And how onerous is it? What are your capital requirements? Is there a way for you to avoid that as part of your business model, and sort of to move to more of a service provider as opposed to an entity that is dealing directly with customers, consumers, or businesses? These are all also important angles to understand as you're building your startup, or as you're looking to establish it here in the UAE. And the last point, dealing with pivoting, and this is a really important point nowadays, especially as we see the regulatory framework in the Middle East and across the world changing and accommodating new technologies. A business model that worked 6 months or 1 year or 2 years ago in a pre-COVID world maybe doesn't make sense right now, or from a commercial perspective or from a regulatory perspective, there are new hurdles that would need to be, or new laws that would need to be complied with that are limiting the ability of this model to be a success. What can you do about that? Can you pivot? And if you can, and if you are pivoting, what are the legal implications of that pivot? Making sure that you're always moving back and centering yourself and asking yourself, well, if this is what I'm trying to do and this is my core offering, am I keeping in line with the regulatory framework? Am I making sure that if this is affecting my IP, that I'm still being able to retain ownership and control over it? And ensuring that you are not trudging into space or into, let's say, a certain regulation or even industry or ecosystem which is more regulated than others. And I can give you a short example here. When we talk about payments, for example, about 4 years ago, a legislation was passed in the UAE for the onshore UAE, which dealt with stored values. And that was the first of its kind at the time. Paralleling this to the EU at that point in time, you still had, your initial PSP1 type of regulation in the EU. And so the UAE had done, the central bank had issued this regulation. Now, the regulation had was a work in progress and was meant to have additional regulations put on top of it. But as technology accelerated and as the market was accelerating, that was kind of put on hold. And for a long time in the UAE, if you were dealing with payments of any kind, you had extremely high barriers to entry. Now, this changed in 2020 quite rapidly with a couple of milestone pieces of legislation being issued. The first in the DIFC, as I mentioned before, the DFSA approving a Category 3D license, which in essence deals with money services, and allowing certain types of companies dealing with payments to establish themselves in the UAE and be regulated by the DFSA. And the second being the central bank overhauling the previous stored values legislation and issuing a new one in October 2020. That has been followed by additional legislations issued by the central bank and the DFSA also looking into issuing new legislations to deal with stored values and to deal with soon to deal with cryptocurrency. So we see that in the span of less than 12 months, a regulatory framework that had been in place for 3.5 years had all of a sudden been wiped out, and you had a completely different regulatory framework to deal with, which meant that as a fintech dealing in the payment space, you're now able to you're now having to rethink your business model, which is a good thing because now you're allowed to do more than you could. But the ability to transition and to pivot is crucial, and you can only pivot as fast as you can understand, what are the changing elements around you. The other point that I wanted to make with regards to this is that when you look at fundraising, which is we had mentioned before, will be an important part of your journey. Also, being able to have these elements already in place and have them concretely in place in a way that there isn't any doubt resting with, from a co-founder perspective, if you've agreed on who needs to be doing what, from a corporate structuring perspective, from an IP perspective, your potential investors will be looking at you a bit differently. And that's what you want to, that's another reason why it's so important to have these building blocks in place from the get-go, let's say from the beginning. We talk about, from a legal perspective, we talk about this a lot, where we prefer that a certain amount of money be spent to get things right at the beginning, as opposed to spending a lot of money later on to rectify things that were done incorrectly, or to have to deal with, fighting fires, which will be costing way more time and delaying a lot more, delaying the progress, let's say, of the entity. And so from a fundraising perspective, that's the first really important element to understand. The second important element is that your ability to enter into agreements with investors will also be tied to what you have agreed to between yourselves as co-founders, and to what your structure is. Have you chosen a jurisdiction where you're only allowed or able to issue one class of shares, and you have investors coming in where they would like multiple classes of shares to be issued? Are you dealing with investors who want to invest in a certain way, don't want to take equity, prefer to sign a safe agreement instead of taking equity, or want to provide you with debt as opposed to a safe note. Understanding what the implications are and having the right structure from the beginning will allow you to be as flexible as possible when it comes to dealing with investors. Now, I bring up the safe note element to bring up one other important element when we talk about employment decisions, which is that when you are a startup and you are at the inception of your idea, and that you are looking to build a business, you will be trying to incentivize employees with what we call ESOPs or SIPs, where basically you're providing them with a certain amount of shareholding. Understanding what that means from a legal perspective, what your obligations are, understanding what that will look like on your cap table is very important. And being able to provide comfort to your employees that you do have a proper ESOP program in place, even if it's just 4 or 5 pages, it doesn't have to be a lengthy 20-page document, but that will give them comfort and will give you comfort that you will know how it needs to be put in place, that you'll know what will happen in the event where you will need to be selling a certain amount of shares and equity to maybe a potential investor, or where you need to be raising funds and diluting these individuals. What it will mean for them and for you is also a very important consideration to keep in mind when talking about fundraising. So I know I've been talking for a long time, but basically these are, based on our experience dealing with startups in the fintech field and in general, probably the most important points that you need to get right from the beginning, from a legal structure perspective and from a legislation perspective. I'm happy to take on any questions that you may have. Allow me to just move over. Let's see if there's any questions. So I'll leave the floor up to you guys if you do have any questions. Okay, just seeing one come in. All right, from Sanjay. So what are the red flags to avoid in shareholders agreements, IP, and ESOPs? Very long answer. I'll try and keep it as simple as possible. When you're dealing with, let's start with shareholders agreements, especially if you're both co-founders, you want to make sure that you are providing terms that are equitable to all. And, depending if you're coming in as a 50-50 co-founder or if you're coming in as a majority or minority, you may have different things to keep in mind. But some of the major points to think about is decision-making. So how are decisions made from a shareholder's perspective? How are they made from a director's perspective? And what decisions are made at the director level, what are made at the shareholders level? If you are bringing in potentially, if you see yourself bringing in an investor in the future, and maybe they might want to appoint individuals to your board, making sure that decisions that you've kept a certain amount of decisions to be made at the shareholders level that you can keep control of. Make sure that if there are any reserved matters are basically matters that will be decided upon between either the directors or the shareholders, where one person, normally the person who either has the most shares or a person maybe that's labeled as a founder, would have a veto right on. Understanding what those reserved matters are and making sure that As a founder, you retain that veto right that when you are negotiating a shareholders agreement where there's a potential investor coming in. Dealing with what happens in in tag along and drag along rights, so or even in ROFRs, so right of first refusal. So what that means is basically what happens if someone else wants to sell their shares? Who can they sell them to? Do they have to first sell them to the existing shareholders and then have a period of time for where they can say yes or no to the purchase? Can they go and sell to any third party and then you are bound to deal with that other third party? If one of your shareholders has gotten favorable terms in a sale, can you tag yourself so that you can sell your shares at that same amount if you want to exit as well? So making sure that you understand exactly what are the rights given when there's a share sale or share transfer, and who is benefiting from it. So there's a lot of template agreements out there when you deal with shareholders agreements, which are either tailored to different jurisdictions or drafted in a way to benefit certain parties, either majority shareholders or minority shareholders. And some of the differences sometimes are really small from a language perspective, and they're written in a very complicated way, which doesn't benefit anyone. So making sure that the clauses are drafted in English, to me, having complicated legalese is a red flag. And if you see that in an agreement, take a step back and ask whoever has provided that to you or whoever's drafting it for you to simplify it. There's no need anymore to have complex legal language when simple legal language and straightforward clauses make more sense. From an IP perspective, depending if you're licensing IP or if you are asking someone to create IP, if it's creation of IP, make sure that you own it. Make sure that you're not providing them with any right in the future or in the present to own, replicate, or make any money from the IP. If you are licensing IP, making sure that you retain control of it and that you're paid properly, remunerated properly, that there isn't an end to the license period, and after that end that they can then go ahead and do their own thing. And this is extremely important if you have a model that is a white label model, where you're creating technology and then you're selling other providers and allowing them to white label it. We dealt with an exit of a software developer, a homegrown FinTech actually, where they had specialized in white labeling their software. And because they had gotten the right advice in terms of how to structure those agreements, they were able to sell an asset out of their books for maybe 30x, because they were able to retain control of it, and no one was able to. Eventually, the competitors, an international entity, had their only recourse was to purchase that asset from them. So making sure that these agreements are properly structured from the get-go is extremely crucial. Finally, on ESOPs, Sanjay, I would say that when you're trying to incentivize your employees, you want to try and be fair to them. At the same time, you want to make sure that you've already set the terms. So have a carved out pool from your shares that will only be for ESOP, and have that decided before you even start providing ESOPs. Making sure that you retain control to buy back the ESOPs at any point in time, so that you can allow yourself some flexibility. And this is something that happens commonly with ESOPs, where a company is doing really well and they've realized, we want to have more of the shares, we want to have more control, and we're willing to buy back the ESOPs at an X, which is beneficial to the employees. And being able to do that is also important. And then lastly, I would say from ESOP's perspective, making sure that whatever you have is actually enforceable in the jurisdiction you're in. Not everything is enforceable not everything is enforceable in the UAE that might be enforceable in the DIFC, and vice versa. But more in that perspective, because the DIFC has a different contracts law and is structured around common law. So I hope that answers your question, Sanjay. Moving on to Adriana, I'll read her question out. Hello, could you further elaborate on the 100% foreign ownership that got into place this month, about its advantages and limitations? Absolutely. The first thing to note is that this does not affect companies that are based in free zones. So any free zone, Abu Dhabi, Dubai, anywhere else, this law doesn't affect what you're able to do. Now, what it does affect is companies that have to be incorporated in mainland UAE, where you must carry out your activity for whatever reason in onshore UAE. And the first amendment to the law was made in late 2019, where it opened the door for companies to be owned at 100%. There was then subsequently a new law passed called the Foreign Direct Investment Law, which has then been repealed with the new circular sent out by the Ministry of Economy a couple of months ago. Now, what's happened here is that they've in essence said any entity that doesn't have a regulator, so let's take the example of banks that have a regulator, financial services that have a regulator, insurance companies have a regulator, anything to do with oil and gas, there's a regulator involved there. So any company that does not have a regulator, you're allowed to own the company at 100%, as long as the economic department in that emirate provides its go-ahead. And what we've seen 2 weeks ago and 3 weeks ago is both Abu Dhabi and Dubai issuing lists of activities which can be owned at 100% in each emirate. These activities have mostly focused on manufacturing and trading activities. There are some other ones as well mixed into there. The large bulk of them have been manufacturing and trading. And what that means is that in effect, you do not need a local sponsor anymore to own 51% of the company. You can own 100% of the shares. Of course, now that provides you added flexibility. I'm sure for those who don't know, those 51% local sponsors were either true shareholders, which were part of the business and provided capital and received profits, or were nominee shareholders, where they did not really own, they were owning the shares on paper, but from a remuneration perspective, they were just acting as nominees and receiving maybe a certain amount of money at the end of every year, just to be there and satisfy that legal requirement. So for a lot of activities now, there's no need for that. Now, advantages and limitations. Right now, the advantages are 100% clear for companies that have been doing everything and just using a nominee shareholder. Companies that have not been using a nominee shareholder and have been using an active one may not need to change or may not want to change. From a limitations perspective, not all activities are included, and that's something to keep an eye on because we feel that more activities will probably be included later on. The last thing I would say, this is purely my opinion, is that the UAE regime has been a pass-through regime for a very long time, and as we see VAT coming into play across the GCC, and corporate tax already implemented in other jurisdictions in the Middle East. While it's not on the radar right now, we anticipate that at some point in time, corporate tax will be at somewhere on a milestone plan for the country, and whether that will affect companies that are owned at 5149 or 100 might be something to keep in mind. But that again, that's just my opinion on that. So I hope that answers your question, Adriana. We have another question from anonymous attendee. Sounds ominous, but I'm going to read it out. How do you navigate a regulatory environment where several regulations apply to your business, central bank and a ATGM as an example, and those regulations do not align? Very good question, anonymous attendee. Very good question. So the first thing is to understand what it is that you're trying to do, because when you start to get to the nuts and bolts of what you're offering as a service, you will be able to figure out, well, what umbrella do I need to fall under? Do I need to fall under a central bank regulation or DIFC ADGM regulation if you want to go through a free zone? Some free zones offer certain things and others don't. And that's another thing to understand. Can I do this in one free zone and not the other? Same onshore. So certain services can only be provided onshore, and free zones don't allow you to do that. Really boiling your business model down to the nuts and bolts to really understand what you're doing. First of all, are you a B2C or are you a B2B? Or are you a service provider, providing a service to anyone? That will help you first understand where you fit, and then understanding whether there are any exceptions to what it is that you're trying to do. Have any exceptions been provided in the past to other entities? Do you need to deal in specific currencies or not? And lastly, engaging with the regulator. I think that is something that is probably undervalued, but you have regulators in this jurisdiction which are happy to be engaged, in both the financial free zones, and happy to hear happy to field questions, and who have sandbox programs made for that. The central bank and ESCA, the SCA, also has sandbox programs. So I would also engage with them. I would say that, again, it depends whether you're here on the ground or whether you are, remote, or whether you're new to the jurisdiction. But in ensuring that you try to engage the regulator directly, I think is something that is very recommended. We get a lot of startups who come to us and ask us to engage with them or for them, which we're happy to do. But my advice is always usually try and engage by yourself before paying someone to do it for you and incurring costs that you don't need to, especially if you're a true startup. I'm not talking about whether if you're an entity that already has funding and you're established in another jurisdiction and you want to go to market ASAP. But if you're a true startup, and if you have the time and you have the capabilities, try and engage the regulator without having to pay someone to do it for you. That is another reason why we encourage startups to go through accelerator programs like the FinTech Hive, because they will put you directly in touch with the regulators. You don't have to worry about it. They'll come to you, and you're going to be able to build relationships, and you're going to be able to ask questions. Now, dealing with the regulators has been a very, the issue that you're talking about here, navigating the environment, is one that is always changing, as I said before, because the regulations are always changing. 2 years ago, there were things that you couldn't even fathom being able to do here because the regulation wasn't there. Now it is. So that, to me, that is where engaging the regulator is important, because you're also able to educate them potentially in certain things that they might not be aware of. Just because they're regular doesn't mean they know everything, and doesn't mean they have the answers to everything. Some of these things are being figured out around the world as we're going along, because the offerings and the technology is so new. So just to summarize, I would first recommend that you understand at a granular level what it is that your business is doing or wants to do. Have a scope, a refined scope. Don't have a very wide offering, then try and say, I want to do all of these things, because then it's going to be a headache to try and navigate. So have a refined scope at the granular level, understand what it is that you're offering. The second thing is engage with the regulator as much as you can, or have someone help you engage with the regulator so that you can understand whether you fall under their umbrella or not, and whether they would be happy to kind of walk through any issues that you might have. And then maybe the last thing that I didn't say yet is that if you have several regulations that apply to your business, to understand that ultimately there might only be one which is overarching over the others. it's a fine line, and sometimes it's a gray area. So it's difficult for me to kind of give you examples now. But there are certain sectors and certain offerings which you could do onshore, you could do in a free zone. And depending on which one you choose, you will have to set certain limitations within your business model. The other thing is that if and when you become regulated / licensed in one jurisdiction, is immediately trying to engage the other regulator to tell them, hey, I'm here, this is what I'm doing, and I just want to make sure that you have greenlit what I'm trying to do, whether it's on a name basis or on a no-name basis. And I guess that's my last tip. Engage on a no-name basis as well, because you don't always have to put everything out there. Okay, you have a follow-up. I like this. Thank you for the explanation. Out of curiosity, we see regulations around the world emerging around BNPL or crypto, and this could potentially disrupt business model, affect customers, etc. This is a risk with new fintechs and business models, since the regulations are catching up after the fact. How can one hedge against the regulatory risks that could affect one's business? I think you're asking $1 million question, anonymous attendee. It's funny because when the first entrant in the BNPL market in the Middle East, which was maybe 2 years ago, they came in and there was nobody else doing it, and there was no regulations around it. Now, fast forward, you have multiple players, and you even have international ones coming in and acquiring local ones. So, the market is way more developed. From a crypto perspective, also, we saw that, initially there was no regulations whatsoever. And now, as regulators are understanding the space more and more, that they are trying to issue regulations. So how do you hedge against this? To be honest, you can't. You can't hedge against the unknown. And so, especially when you're dealing with nascent and cutting edge technology, you need to make sure that you are up to date with everything that is happening, and that you're able to adapt your model quickly and efficiently. And that's why when I spoke about pivoting earlier, it's crucial. Pivoting is crucial for startups, but especially in fintech, because it's a changing space. A lot of times when we have, especially with new ideas, we will see startups, maybe the first one to come up with a new idea, launch, and the regulations are not there yet. And now they need to have a runway long enough to survive for, one, the regulation to be actually issued, and two, for them to be able to adapt to the regulation, because they most probably will need to adapt to the regulation. And a lot of times that first initial startup that comes up with the idea doesn't have that long. And it's number 2 or number 3 or number 4 that come in that either are non-local or have more runway, that are able to withstand this, this issue that you've, very well pointed out. The other, going back to the last point that I mentioned, which was approach on a no-name basis. Look, as a lawyer wearing my lawyer hat, for me, it's, you need to watch out. You need to know your risks. You need to understand them 100% and be able to mitigate them. And especially when it comes to legal risks. But at the same time, when there is an advantage for you to try and build a certain business in an area that is, let's say, unclear or unregulated, so that you might be the first person to engage the regulator to have the space regulated. So if you came up, let's take ride hailing as an example. Ride hailing, didn't exist until Uber decided to enter the space. And they basically, in some countries, were doing things which were not against the law, but were clearly in a gray area, and laws are passed to stop them from operating their business model. And a lot of times they had to completely stop and cease all operations in certain jurisdictions. UE is one of them, and they engaged with the regulator to try and find a common ground and a way for this to be able to progress. And they were successful in doing it. Some jurisdictions you weren't able to, but that again shows you that from a UE perspective, if you're able to engage with regulators and you really have a business model that is, that has proven itself, you will be at an advantage. And it won't really maybe it's a bit utopian, but it won't be any more about regulations catching up with you and you having to hedge, but more about you're able now to mold the regulation by being the first on the ground. I hope that answered your question, anonymous attendee. Please do let me know. Bye-bye, take care.